A rule buried inside a 412-page Social Security Administration policy update, effective January 2024, is quietly stripping $12,000 per year from retirees who have no idea it applies to them. It is not a penalty. It is not a tax audit. It is a recalculation. The Social Security Administration is using a revised interpretation of the Windfall Elimination Provision, combined with a new cross-agency data matching protocol with the IRS, to reduce, suspend, or partially claw back benefits from millions of Americans who worked both public and private sector jobs. You may already be affected. Your next direct deposit may already be smaller. And if you do not act before the 60-day response window closes, the reduction becomes permanent. Here is what I am going to show you in the next 22 minutes. Change number 1. The revised Windfall Elimination Provision formula, updated under SSA Program Operations Manual System Section GN00307.290, is now being applied retroactively to benefits already in payment. I will show you exactly which workers are exposed and the specific dollar thresholds that trigger a recalculation. Change number 2. A new IRS-SSA data bridge, authorized under the Bipartisan Budget Act provisions expanded in 2023, is quietly feeding your tax return data to the SSA every single quarter. I will show you what they are looking for and how ordinary income is triggering flags you never expected. Change number 3. The government pension offset, a rule that has existed since 1977 but is being enforced in a newly aggressive way, is hitting surviving spouses in ways the original law never intended. I will show you the specific pension types now under review. Change number 4. A rarely cited provision inside the Social Security Act, Section 1129, allows the SSA to impose civil monetary penalties up to $7,500 per violation for what they classify as material misrepresentation, even when the mistake was made by a benefits counselor, not you. Change number 5. There is a little-known correction mechanism, the earnings reconsideration request, that almost nobody uses. It can recover every dollar of an improper reduction. I will show you how to file it, step by step. My name is David Harlan. I am an enrolled agent with over 20 years of experience representing taxpayers and benefits recipients in front of the Internal Revenue Service and the Social Security Administration. What I am about to show you is not financial planning. It is not tax planning. It is survival planning. The protection moves come at the end of this video. Do not skip ahead. Every piece of context I give you before minute 21 is the reason those moves will work. Stay with me. Raymond and Patricia Kowalczyk are both 68 years old. They live in Youngstown, Ohio. Raymond spent 22 years as a public school teacher in Mahoning County, retiring in 2014 with a state pension of $2,340 per month. Patricia worked 19 years in private manufacturing, paying into Social Security every single paycheck from 1979 to 2001. In the spring of 2023, Patricia began receiving her Social Security retirement benefit, $1,614 per month, a number they had planned their entire budget around. In October 2023, a letter arrived. It was not from the IRS. It was from the Social Security Administration's Office of Program Integrity out of the Philadelphia Processing Center. The letter referenced Form SSA 795, a statement of claimant or other person, and stated that a cross-reference of Raymond's Ohio State Teachers Retirement System records against IRS filing data for tax year 2022 had triggered a review under the government pension offset provision. The letter gave them 30 days to respond. They did not understand the letter. Raymond took it to their local SSA field office on Market Street. The claims representative spent 11 minutes with them, handed them a pamphlet, and told them their case was under review. 3 months later, Patricia's benefit was reduced from $1,614 to $657 per month. Not suspended, not frozen. Reduced permanently, with a determination letter citing government pension offset calculations under 20 CFR Part 404, Subpart D. That is a reduction of $11,484 per year. They had done nothing wrong. Patricia had paid into Social Security for 19 consecutive years. Raymond's pension was from an entirely separate system. They had filed every tax return accurately. They had reported every dollar of income. Raymond and Patricia Kowalczyk did nothing wrong. And this is exactly what is happening to ordinary American retirees every single day. It is happening now. It is happening this month. It is happening in all 50 states. The difference between Raymond and Patricia and the retirees who keep every dollar they earned is not wealth. It is not luck. It is information. Specifically, the 5 pieces of information I am about to give you. The Windfall Elimination Provision, encoded in Section 215A of the Social Security Act, 42 U.S.C. Section 415A(7) was created in 1983 to prevent workers from receiving what Congress called a windfall benefit. The logic was this: the Social Security benefit formula is designed to replace a higher percentage of income for lower wage workers. Someone who spent most of their career in a non-covered public sector job, paying no Social Security taxes, and then worked a few years in a covered private job would appear to the formula as a lifetime low-wage worker. That would give them an artificially inflated Social Security benefit. The WEP was meant to correct that. Here's the problem in 2024. The SSA is now applying a recalculation methodology, documented in Program Operations Manual System Section RS-00605.360. That uses IRS reported income data to re-examine the substantial earnings threshold going back as far as 1978. For 2024, that threshold is $31,275 per year of covered wages. You need 30 or more years above that threshold to be completely exempt from WEP. Fewer than 20 years of substantial earnings means the maximum WEP reduction applies, currently $587 per month or $7,044 per year. Let me tell you about the real people this has happened to. Gerald Fontaine, age 71, of Baton Rouge, Louisiana, worked 17 years for the Louisiana State Police, a non-covered pension system, and then spent 14 years in private sector logistics, paying into Social Security. When he filed for benefits in 2021, he was told the WEP would reduce his benefit by $312 per month. He accepted that. In 2023, following a cross-match of his IRS W-2 history against SSA earnings records, the SSA determined that 3 of his 14 private sector years fell below the substantial earnings threshold for those years. His WEP reduction was recalculated upward to $501 per month. That is an additional $2,268 per year, applied retroactively with a $4,100 overpayment demand attached to it. Here is how ordinary behavior triggers this. If you worked any combination of a state, county, or municipal job with its own pension system, a federal job under the old civil service retirement system before 1984, a job at a railroad which has its own retirement system under the Railroad Retirement Act, a foreign employment job not covered by a U.S. Social Security agreement, and you also worked private sector jobs covered by Social Security, your record is now under automated review. The SSA's Enterprise Data Exchange System, integrated with IRS tax records under a 2022 data sharing agreement, is running these checks without any notification to you before the fact. Subpoints to know: the WEP does not apply if you have 30 or more years of substantial covered earnings. It does not apply to survivor benefits your spouse may receive on your record. It applies separately to each person in a household. Raymond and Patricia's situation involved the GPO, not the WEP, but many households face both simultaneously. The maximum WEP reduction for 2024 is $587 per month. It can never reduce your benefit below 50% of your pension amount. Write this down: 30 years. $31,275 per year. Those two numbers are your protection threshold. In February 2023, the Social Security Administration and the Internal Revenue Service formalized an expanded data sharing protocol under authority granted in Section 6103L1 of the Internal Revenue Code. That section authorizes the IRS to disclose return information to the SSA for the administration of Social Security programs. What is new is the frequency and granularity of what is being shared. Previously, the SSA received annual earnings summaries. Now, under a quarterly matching cycle, the SSA is receiving Schedule SE data, self-employment income and net earnings, 1099-R distribution codes, specifically codes 2, 3, and 4, which indicate early distributions, disability, and death. Schedule C net profit figures, 1099-SSA cross-reference data to verify benefit amounts match SSA records. Here is why this matters for retirees specifically. If you are under full retirement age and receiving Social Security benefits, you are subject to the retirement earnings test under 20 CFR, Section 404.430. For 2024, if you are under full retirement age for the entire year, $1 in benefits is withheld for every $2 you earn above $22,320. If you reach full retirement age in 2024, the threshold is $59,520. The IRS-SSA data bridge is now catching self-employment income, consulting income reported on 1099-NEC forms, and Partnership K-1 distributions that beneficiaries failed to report to the SSA because they did not know they were required to. Let me tell you about the real people this has happened to. Margaret Ostrowski, age 64, of Scottsdale, Arizona, began taking her Social Security benefit at 62. She retired from her accounting career but continued doing bookkeeping work for 3 small businesses, a total of $31,400 in 1099-NEC income in 2023. She reported that income to the IRS on Schedule C. She did not report it to the SSA because no one told her she had to do so separately. In early 2024, Margaret received an SSA overpayment notice for $9,240. The amount of Social Security benefits she received during the months her earnings exceeded the retirement earnings test threshold. That notice came with a demand for repayment within 30 days, or automatic withholding of her entire monthly benefit until the debt was satisfied. It is not that Margaret cheated. It is not that she lied. It is that she did not know the SSA and IRS were now talking to each other in real time. The solution to this specific trap is a Retirement Earnings Estimate Form, SSA 131, which allows you to report anticipated earnings to the SSA before the end of the tax year so benefits can be voluntarily adjusted in advance rather than clawed back afterward. Filing an SSA 131 proactively eliminates the overpayment trigger entirely. The government pension offset, codified at 42 U.S.C. Section 402(b)(4), reduces the Social Security spousal or survivor benefit of anyone who receives a pension from a federal, state, or local government job not covered by Social Security. The reduction is dollar for dollar. 2/3 of your government pension is subtracted from your Social Security spousal or survivor benefit. For many surviving spouses, this wipes out the Social Security benefit entirely. Here is what is new. The SSA is now cross-referencing state pension records using data sharing agreements now active in 34 states to identify surviving spouses who were previously miscategorized or who experienced a change in pension status after the initial benefit determination. The enforcement focus has shifted to 3 specific pension types. Teacher pension systems in states including Ohio, Illinois, California, Colorado, and Massachusetts. State and municipal police and fire pension systems. Federal employees under the Civil Service Retirement System who retired before January 1st, 1984. If your spouse had a pension from any of these systems and you are now receiving a Social Security survivor benefit, your file may be under review right now. The specific dollar consequence: a surviving spouse receiving $1,800 per month in Social Security benefits whose late spouse received a government pension of $2,100 per month faces a GPO reduction of $1,400 per month, 2/3 of $2,100, reducing the surviving benefit to $400 per month. That is a reduction of $16,800 per year. It is not a tax. It is not a penalty. It is a calculation, but for families living on fixed incomes, the impact is indistinguishable from either. What protects you here is documentation. The SSA's GPO exemption requires proof that you paid into Social Security during the last 60 months of government employment. That proof must be in the form of W-2s from the government employer showing Social Security withholding. Many retirees do not have those W-2s anymore. The IRS retains transcripts going back to 1978. Requesting a wage and income transcript, IRS Form 4506-T, line 8, gives you the documentation you need. This is the change that almost nobody is talking about, and it is the one that carries the sharpest financial consequence for retirees who were simply given bad advice. Section 1129 of the Social Security Act, codified at 42 U.S.C. Section 1320-8, authorizes the SSA to impose civil monetary penalties of up to $7,500 per violation for any statement, omission, or representation that is material to a determination under a Social Security benefit program. That word, material, is doing enormous work in this law. Here's the scenario playing out across the country right now. A retiree visits an SSA field office or uses the My Social Security portal to update their earnings information, marital status, or living arrangement. The claims representative, whether in person or via the system, records the information incorrectly. The retiree receives a benefit level based on that incorrect entry. The SSA later determines the benefit was overpaid. Under Section 1129, the SSA can assess a penalty against the beneficiary, even if the beneficiary did not knowingly provide incorrect information. The standard for liability under Section 1129 is not intent. It is whether a reasonable person should have known the information was incorrect. Let me give you the specific dollar exposure. In 2023, the Office of Inspector General for the Social Security Administration documented 14,800 civil monetary penalty cases. The average assessed penalty was $4,316 per case. Total penalties collected exceeded $63.8 million, a record. The OIG has publicly stated that enforcement of Section 1129 is a top priority for fiscal year 2024 and 2025. It is happening now. It is happening this year. It is accelerating quarter by quarter. Your protection here is a written record. Every interaction with the SSA, by phone, in person, or online, should be followed within 48 hours by a written confirmation letter sent by certified mail to your local SSA field office. That letter should state the date of contact, the name or ID number of the representative, and your understanding of what was recorded. This creates a contemporaneous record that shifts the reasonable person burden squarely back onto the agency. Most retirees who receive an adverse SSA determination, a benefit reduction, a suspension, an overpayment demand, accept it. They should not. Under 20 CFR Section 404.907, every Social Security beneficiary has the right to request reconsideration of any initial determination within 60 days of receiving the notice, plus 5 days for mailing. That 65-day window is not optional, and it is not extendable without a showing of good cause. But here is what almost nobody knows. The reconsideration process for earnings-related determinations, including WEP recalculations and retirement earnings test adjustments, is a separate administrative channel from standard appeals. It is called an earnings reconsideration request, and it is filed on Form SSA-561-U2. It is not the same as an appeal. It does not go to an administrative law judge. It goes directly to a reconsideration unit inside the program service center, where a different claims examiner reviews the earnings record from scratch. Here is why that matters. The reconsideration examiner has the authority to correct wage credits that were misposted to your record, credit earnings that were reported by your employer but never properly associated with your Social Security number, a surprisingly common error for workers who changed names after marriage or worked under multiple Social Security numbers prior to SSA's 1972 cleanup effort. Apply substantial earnings credits for years where gross earnings were above the threshold but net earnings were slightly below. Restore benefits retroactively to the month of the original incorrect determination. The average successful reconsideration in an earnings-related case recovers $8,400 in benefits, according to SSA internal data cited in the 2023 Social Security Advisory Board Annual Report. There is a sub-tool within this process that is even more powerful. It is called a Detailed Earnings Query, SSA Form SEQY, and it produces a line-by-line, year-by-year printout of every dollar of earnings ever associated with your Social Security number. Comparing that printout against your IRS wage and income transcripts reveals discrepancies, and discrepancies are the basis for corrections worth thousands of dollars. It is not complicated. It is not expensive. It is a matter of knowing the form numbers and filing in the right sequence. Here are your 5 protection moves. Execute them in this order. Request your Social Security earnings record immediately. Go to ssa.gov and access your My Social Security account. Download your complete earnings record. Compare it line by line against your IRS wage and income transcripts, requested on Form 4506-T. Any year where the SSA record shows lower earnings than the IRS record is a potential correction worth filing. Do this before you receive any adverse notice. Do it this week. If you are under full retirement age and receiving benefits, file Form SSA 131, Employer Report of Special Wage Payments, or, for self-employed individuals, contact your local SSA office to submit an anticipated earnings estimate before December 31st of the current tax year. This single step eliminates the overpayment trigger entirely and costs you nothing. If you or your spouse received a pension from any non-covered government employer, pull the W-2s from your final 60 months of government employment. Confirm whether Social Security taxes, FICA, were withheld. If they were, you have documentation for a GPO exemption. If you no longer have those W-2s, file IRS Form 4506-T immediately to obtain wage and income transcripts. The IRS has records going back to 1978. This documentation does not expire. After every SSA interaction, phone call, office visit, or My Social Security online update, send a written confirmation to your local field office by certified mail within 48 hours. State the date, the nature of the interaction, and your understanding of what was recorded. Keep the certified mail receipt. This is your shield against Section 1129 civil monetary penalties. If you have already received a reduction notice, suspension notice, or overpayment demand, do not wait. File Form SSA-561-U2, Request for Reconsideration, before the 65-day window closes. Attach your IRS wage and income transcripts, your SSA earnings record, and a cover letter identifying every discrepancy by year and dollar amount. You can recover years of reduced benefits. The Reconsideration Examiner has full authority to restore retroactive payments. And now the bonus move. I call this the Senior Earnings Shield Protocol. This is a two-document combination, a notarized letter of explanation and a substantial earnings certification, that you file simultaneously with SSA and retain in a physical binder with your tax returns. The letter of explanation documents your complete employment history, every employer, every pension system, every year, and whether Social Security taxes were withheld. The substantial earnings certification is a year-by-year attestation, signed and dated, confirming that your earnings record as reported to the SSA is complete and accurate to the best of your knowledge. When the SSA's automated data matching system flags your record, and for the households I described today, it will, this two-document package is what stops an automated reduction from becoming a permanent one. I have put together a 47-page guide that walks you through every step of this process. It includes the exact language for the certified letter, a template for the substantial earnings certification, a complete list of non-covered pension systems by state, and the specific form numbers for every filing I described today. It is completely free. The link is in the description below. In the next video, I am going to show you something that will change how you think about Medicare Part B premiums. Specifically, a 2024 rule that is causing thousands of retirees to overpay by $2,880 per year because of a single line on their tax return that they have the legal right to change. If you know someone over 60, a sibling, a neighbor, a friend who retired from a government job, share this video with them today. Not tomorrow. Today. The 65-day window does not wait. Like this video. Subscribe to this channel. You now have information that most retirees will never find on their own.